In the spring of 1720, Sir Isaac Newton owned shares in the South Sea Company. As the hottest stock in England surged in price, Newton sensed the hype was getting out of hand and sold, pocketing a massive profit. But the market kept rising. Swept up in the frenzy, the man who mapped the laws of gravity jumped back in at the absolute peak and lost the modern equivalent of $3 million. Baffled and broke, Newton realized he could calculate the motions of the heavenly bodies, but not the madness of the people. No amount of raw intellect could save him once logic broke down and the crowd took over. 3 centuries later, that madness persists. Walk onto any trading floor or look at how millions of people manage their retirement accounts, and you see the same patterns. People treat the stock market like a casino, constantly trying to guess which flashing number will spike next. History reveals a market pendulum, a force that constantly swings between unsustainable optimism, which makes stocks far too expensive, and unjustifiable pessimism, which makes them far too cheap. You cannot predict those swings, but if you understand the actual underlying mechanics of value, you can stop guessing and force the pendulum to start working for you. There are 2 ways to play this game. The first is to play as a speculator. A speculator looks at a stock and sees a digital ticker symbol. Their entire strategy is a gamble that if they buy a stock today, someone else will pay a higher price for it tomorrow. We saw this play out on a massive scale during the late 1990s dot-com boom. As the internet went mainstream, investors threw money at any company ending in .com, confident that the prices would simply go up forever. Take VA Linux, for example. In December 1999, without a shred of reliable profit or business value to support it, hype drove the stock up by hundreds of % in a single day. The price soared because buyers saw everyone else buying. But hype evaporates. Within months, the buying frenzy ran out of oxygen, and the stock was crushed, falling to a fraction of a penny. Buying an asset purely because its price is going up eventually guarantees a catastrophic loss. In 1949, Benjamin Graham described this volatile environment through a metaphor. He asked us to imagine a manic-depressive business partner named Mr. Market, who knocks on your door every single day, offering wildly different prices to buy or sell your shares based on his own irrational moods. The speculator fails because they surrender their financial agency to Mr. Market. They let a stranger's emotional mood swings dictate exactly when they buy and sell. The alternative is to act as a defensive investor. Instead of staring at a flashing number, a defensive investor sees a stock as an ownership stake in a physical, operating business. They look past the screen to the assembly lines, the inventory, and the cash in the bank. Benjamin Graham taught that a company's underlying business value exists completely independently of whatever price Mr. Market happens to be shouting today. To protect that value, Graham insisted on a discipline he called the margin of safety. You calculate what a business is actually worth, and you simply refuse to overpay for it, no matter how exciting the current narrative gets. Instead of getting swept up in the pendulum swing, the defensive investor exploits it. When the crowd is gripped by unsustainable optimism, the defensive investor sells to them. When the crowd is paralyzed by unjustifiable pessimism, the defensive investor buys up their bargains. This process is executed through dollar-cost averaging. By investing a fixed, automated amount of money on a set schedule, the math works in your favor. Your fixed cash deposit automatically buys more shares when prices dip, and fewer shares when prices peak. By utilizing tools like broad index funds and dollar-cost averaging, the defensive investor puts their portfolio on permanent autopilot. They insulate their wealth by removing human emotion from the equation. Graham's philosophy eventually reaches an uncomfortable conclusion. The real obstacle to building wealth isn't the market, it is your own brain. We are hardwired to seek out patterns, and we process the pain of financial loss more than twice as intensely as the pleasure of an equivalent gain. That loss aversion makes the flashing lights of the stock market addictive and dangerous to our decision-making. A market drop triggers a biological panic, screaming for you to sell. But that fear has no bearing on the actual earnings or assets of the businesses you own. While the crowd reacts to noise, the defensive investor ignores the vibrations to focus on the tangible metrics of the business. Because you cannot control the pendulum or Mr. Market, The only path to success is strictly governing what you can, your own behavior, your trading costs, and your diversification. Graham noted that in the short run, the stock market is a voting machine, a popularity contest driven by the whims of the crowd. But in the long run, the market is a weighing machine. Eventually, the hype burns off, and a company is judged exclusively by its actual business earnings and fundamental value. The 2000 market crash proved this. In the late 90s, Yahoo won the popularity contest, carrying an astronomical valuation despite barely earning a profit. Meanwhile, investors ignored boring, tangible companies like Yum Brands, the corporate owner of unglamorous fast food restaurants. Between 2000 and 2002, the weighing machine kicked in. Yahoo lost 92% of its value as its paper-thin earnings disappeared. On the exact same timeline, Yum Brands generated actual cash profits, and its stock gained 25%. True intelligent investors do not waste time trying to predict the chaotic future. They prepare for it. They secure real value, they put their strategies on autopilot, and they sit quietly while the market pendulum swings harmlessly by.